This video is sponsored by MobiRich. More on them later. Legal & General has had a volatile start to this year by its own standards. In the last month alone, the stock has fallen 17% before quickly rebounding nearly 14% off the lows. Despite rallying substantially in March and April, I think Legal & General is underappreciated by the market. And with a current dividend yield of 7.74%, I'm buying more. So, what exactly happened to Legal & General, and why do I think it has the potential to rise from here? This video will dive into the company in more detail. I must say that this is not financial advice and purely my own thoughts on the stock. I would always advise doing your own due diligence before investing. Welcome to Wisewell, where we dive into all things personal finance. If you like this type of content, make sure to give it a like down below and subscribe to the channel for more personal finance and investing content. Hit the bell icon to make sure that you get notified when any new videos are released. Without further ado, let's get into it. For those of you who aren't aware, Legal & General is a UK-based financial services provider, with company segments including retirement, investment management, and insurance. Due to the nature of its business, the company generates a steady cash flow and returns a large portion of capital to shareholders in the form of dividends, making the stock one of the best income sources on the FTSE 100. You'll find it in the top 10 holdings of many UK income funds for this reason. L&G has a strong track record of dividend payments. With a shaky few years leading up to the Great Financial Crisis and a cut in 2011, the stock has massively increased dividends steadily from 2012 onwards. What was an annual payout of 7.65 pence per share in 2012 has now grown to 19.37 pence per share in 2022, representing an impressive 253% dividend growth over 10 years. What I'm more impressed about is its recent performance amid a challenging macroeconomic environment. In March of this year, L&G lifted its dividend 5% as it posted a jump on full-year operating profit of 12% to £2.52 billion, beating consensus estimates of £2.46 billion. Chief Executive Nigel Wilson put this down to the diversified nature of the business, with a highly synergistic business model continuing to deliver significant benefits. Our balance sheet is strong and highly resilient, with a record solvency ratio of 236%. Earnings per share increased to 38.33 pence per share, giving the company a dividend cover of 1.98. So despite raising the dividend yet again, the payout remains well within the company's ability to pay without the use of debt. In fact, Legal & General has actually emerged stronger than it used to be pre-2020. The full year 2022 dividend is higher than it has been over the past 5 years, from both an absolute and percentage standpoint, while also remaining the lowest proportion of earnings per share. Meaning, if there ever was an opportune time to invest in the stock for dividend safety, it's today. Now, you wouldn't think that given such a strong full-year performance, robust balance sheet, and dividend yield vastly outperforming the index, that Legal & General would be trading at a premium. Well, you'd be wrong. At today's price of 250 pence per share, the stock is only trading at 6.5 times earnings. This is well below the FTSE 100 market average of 12.4 times, and even the wider financial sector of 9.5 times, making it relatively attractive from a valuation standpoint. Comparing it to the S&P current price to earnings ratio of 18.5 times, this highlights the stark contrast in investor confidence between the two countries, with many betting that the UK will continue to witness a low-growth, low-productivity environment. And while that may be true, L&G has been able to largely sidestep a weak macroeconomic environment and continue to generate impressive results. So has the market mispriced Legal & General? I think so, and I'll discuss why after a quick word from today's sponsor. MobiRich is an Android app users can install to earn money passively by sending and receiving SMS messages. So how does it work, and why does MobiRich pay you to use it? SMS aggregators and SMS marketing services need to test the quality of their SMS delivery when they send them to subscribers from different countries. MobiRich pays you to use your phone number for these tests. When you receive a message, the app automatically records how quickly and how well the message was delivered. It's that simple. You help improve the quality of mobile operators and are rewarded for your help. Regarding safety and privacy, MobiRich adheres to GDPR privacy policies. The application collects exclusively technical data on the quality of SMS delivery, and the app does not collect or use private messages, their content, information about senders, and so on. For more information about MobiRich, visit their website or head to the Android store to download the app or get in touch directly with them. Details are in the description below. Anyways, back to the video. So why exactly do I think that Legal & General is undervalued by the market? I think it's twofold. Firstly, due to the weak outlook for the UK market as discussed earlier, and secondly, due to the overspill of the recent banking turmoil. As Silicon Valley Bank collapsed in March, there was an indiscriminate sell-off of any company globally within the financial services industry, irrespective of whether they could be affected in any similar way. Investors irrationally rushed to exit their positions, and Legal & General was caught up in the midst of all of this. The stock fell 17% to a low of 220 pence per share, nearly falling to its 52-week lows seen during the LDI crisis in the UK, despite feeling the reverberations of what was now known to become an idiosyncratic risk more than anything systemic. What I think was more worrying for the stock was the fall of Credit Suisse. Investors were worried that asset holders, such as Legal & General, could be exposed to counterparty risk if Credit Suisse went bankrupt. There was a broad sell-off in Europe that targeted the likes of Deutsche Bank, SocGen, and BNP Paribas to name a few, which dragged the overall sector down. And despite the risk subsiding amid the forced acquisition of Credit Suisse by UBS, Legal & General is still yet to return to the price it was trading at before fear gripped the markets. Given the low valuation relative to the sector and FTSE index, strong performance of full-year earnings, and favourable investor capital return program, I think Legal & General should be trading above £3 per share. A consistent 7.74% dividend yield that is steadily rising year on year is rarely seen, and an opportunity that I think should not be missed. If you're interested in more dividend stocks on the FTSE 100, I've included my top 5 in a recent video, which also includes Legal & General. Click on the banner in the top right hand corner to go there. All in all, I think Legal & General is a well-diversified business run by an excellent management team, and a fantastic stock for passive income. Let me know in the comments below. Do you hold Legal & General in your portfolio, or are considering to in the future? If you enjoyed this video, smash the like button down below, and remember to subscribe to the channel for more personal finance and investing content. Thanks for watching, and until next time, see ya.